You want to see my ugly mug, but I wouldn't recommend it. And let me get my buttons all figured out, and we can get started here shortly.
I guess that means we're probably live in multiple locations, right?
We are live in multiple locations because we're also live on the Bitcoin Effect. I think, Log, you've got us live on Bitcoin Spot too, don't you?
I have been streaming, I don't know, about half the content to YouTube.
Okay.
And so I don't really have a, I still kind of experimental, and I haven't really decided what to stream and what not to stream. So I'm just kind of doing it based on my mood.
Okay, then hopefully we can keep you in a good mood. And with that, I will go ahead and get this party started. Today on the Bitcoin Effect, we're going to talk about a couple of things. We're going to talk about the new paper that came out from Fidelity called Bitcoin First, and why investors need to consider Bitcoin separately from other digital assets. I want to discuss whether or not there's actually going to be an effect from that paper, because it seems to be a lot of information that you and I have been regurgitating over the last 5 years anyway. Another thing I want to talk about is the question, can the Fed fix what's going on without causing a recession? Because it looks like we're faced with death by either inflation or by rate hikes. And to dig down a rabbit hole here, I'm going to ask the question, and it's going to sound like a conspiracy theory, but it's fodder for good conversation. How long does it take, and I actually want some of the people that are more financially knowledgeable than I am to answer this question. How long does it take to actually cause a recession to occur if you are to either, cut off the money supply or start raising rates? Because if the answer is close to what I think it is, then I got to ask the question, could this be politically motivated? Could it be politically driven, and could it actually are they trying to cause an atmosphere within the what would be upcoming election cycle? So we're going to talk about those two things, and then I'm going to throw out an opinion of mine, and it's this. Bitcoin citadels. I think that they are societal and political shitcoinery. We will talk about that right after this.
What on earth got you interested in Bitcoin and cryptocurrency?
Okay, so what's Bitcoin?
Bitcoin is...
So what's Bitcoin?
Inflation-resistant money.
Bitcoin is the strongest asset the human race has ever invented.
Okay, so now that I've got your appetite whetted for that conversation, let's go back and talk about the Fidelity paper. I take a look, a matter of fact, I had a digital conversation with Jack Newruder. He would love to have come on this program and had a conversation, except for the fact that because he works for Fidelity in this big corporate rigmarole, they have to kind of keep him quiet. Otherwise, it looks as though he's representing their interests on different podcasts or content sites. And so I totally understood that. But I think that he and I will probably have a conversation sometime later on when the heat of this particular paper isn't quite so hot. But I go through this paper, and I actually read all 26 pages this afternoon, and I'm looking at this and say it's best understood as a monetary good and store of value. What they do, though, Fidelity actually stakes their position that they urge analysis of Bitcoin separate from other digital assets. It recommends Bitcoin as the entry point for traditional exposure, which I think we disagree with. We think it's the only point for traditional exposure. They actually go over the virtuous circle, which is how Bitcoin continues to gain network and gain security at the same time. They stake a position that Bitcoin is unlikely to be superseded as a monetary good by any other digital asset. And I think we all agree with that, those of us that are in this room on a regular basis. And he explains well the blockchain trilemma when it comes to security, scalability, and decentralization. But here again, I want to open this up to you guys. I want to say, does this have any impact? Does this publication really have any impact? Does it change anything? Because like I said, we've heard all of these ideas before. But does the credibility of the Fidelity name give this message any more weight? So, Log, I'll ask you first. What are your thoughts on the Fidelity paper? Did you get a chance to read it? And do you think it's really going to make any changes to anything?
I haven't gotten a chance to read it, but just looking at the summary, And the fact that it's from Fidelity, I think it's a big deal. That's like one of the most respected names, in traditional finance and just in terms of, Main Street. And they've been, but it's not a surprise because Fidelity has understood Bitcoin for a long time. And famously, they even began mining it, I think in 2014. So you think about that, like a Main Street financial institution mining Bitcoin in 2014, that is way, 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 way ahead of the curve. And so it's not surprising, but I think it still is significant because I think a lot of people out there, kind of look to Fidelity as being a respectable source with Fidelity.
Anthony, you're on the stage, and you asked for to come up here, and you're in the financial background. So, what are your thoughts on this?
It's a good paper. It's like good to see people thinking critically in mainstream finance, like about these things. That's the first thing. I haven't actually finished the paper, so I'll get there probably tonight. But it is, Log kind of touched on, like Abigail Johnson has supported Bitcoin and research into Bitcoin at least for a long time now. I think Bob Mickelrath even worked there. There's been a number. The regulatory framework has been pretty much the biggest inhibitor. Like, let's not forget that this report came from Fidelity Digital Assets. So just by virtue of having set up a group to do such R&D, I think it's like pretty meaningful, right? But the paper in and of itself, other than like the incremental awareness it gets, I think is just kind of, steady state velocity for Fidelity, a company that's always on the lookout for like what's going to disrupt them. And I think this is one thing that they identified a long time ago that they think needs to be on their platform in some way, shape, or form. The biggest thing holding them back is regulation, I think, at this point,
So basically, it sounds as though they're trying to woo the institutional investors or their larger investors into taking a look at digital assets. But do they really have a product to offer them if they actually convince them that this is the right thing to do?
They had back in 2014 and 15 traded within a digital asset group at Fidelity. I don't know how they segmented the customer base, but they were piloting it. And I believe they ultimately shuttered that. And I think the reason for shuttering that at that time was regulatory issues. I don't know much more beyond that, but I'll take a look at some notes from back then while you guys are talking, and I'll come back when I found what happened there.
Well, read fast. We want you back. Anybody else on the stage? Tao, I'm going to change because you were all about security here just a second ago, and now I'm asking you to consider the ramifications of the publication from Fidelity of this paper. What are your thoughts? As he goes straight to listener. Anybody else on the stage that wants to chime in on the Fidelity paper and what you think it's going to do short term and potentially medium term as far as the investment market is concerned for Bitcoin?
Yeah, I cannot comment because I didn't read the paper either. So, no words. Although obviously it's good that we have that kind of conclusion, but but at the same time, I wouldn't be surprised they change their opinion middle year again. So I would never trust whatever this institution says anyway.
The thing about this, though, is that it really stakes a position on a number of different things. First, specifically, actually, let me just kind of read the proposals that are here in the paper on page, I think it's 2. In this paper, we propose, and I'll just quote this off of the paper, Bitcoin is best understood as a monetary good, and one of the primary investment theses for Bitcoin is as the store of value asset in an increasingly digital world. Next, Bitcoin is fundamentally different from any other digital asset. No other digital asset is likely to improve upon Bitcoin as a monetary good because Bitcoin is the most, relative to other digital assets, secure, decentralized, sound digital money, and any, quote, improvement will necessarily face trade-offs. Next point, there is not necessarily mutual exclusivity between the success of Bitcoin network and all other digital asset networks. Rather, the rest of the digital asset ecosystem can fulfill different needs or solve other problems that Bitcoin simply does not. Not as though that's a bad thing, from my perspective. Obviously, that last part was added by me. Next point, other non-Bitcoin projects should be evaluated from a different perspective than Bitcoin. We think that's obvious. Next, Bitcoin should be considered an entry point for traditional allocators looking to gain exposure to digital assets. In the intro, I already kind of addressed that. And finally, investors should hold two distinctly separate frameworks for considering investment in this digital asset ecosystem. The first framework examines the inclusion of Bitcoin as an emerging monetary good, and the second considers the addition of other digital assets that exhibit venture capital-like properties. And I thought that was a big phrase, because I think that Fidelity is kind of merging in with Gary Gensler's understanding that Bitcoin is not a security, but everything else that's out there in the digital asset world is. So that's the gist of the paper. And like I said, I'm going to take this paper and I can literally create content for the next 8 weeks, based on what is Bitcoin, the network versus the asset, not compatible with other networks. It's got a great graph here as far as why we believe Bitcoin is the best understood as a monetary good. And it goes over the 7 different functions of good money: durability, divisibility, fungibility, portability, verifiability, scarcity, and track record. And obviously the only one check that Bitcoin doesn't check off is track record, because it's only been around for 13 years. But for Fidelity to put this out with their name on it, not just the 2 authors, but to put that out with their name on it, I think it holds a lot of value. Now, whether or not it's going to change the mind of any politicians that are in Washington, I don't know. But that's for fodder for another day. So that's
quick comment
yeah.
on Bitcoin being only 13 years old. I think so is pure fiat. Well, 50 years old, and 13, that's a quarter of the history.
Yeah, that's true. You consider many of the people that are in Bitcoin have only been alive half the time that Bitcoin's been in existence. Well, I've been alive I've only been alive for almost the entire time that fiat's been in existence. So there's that too. And I've discussed this as well. Say, hey, we've never been part of a sound money system. We have no idea what we're doing because we weren't even taught it when we were kids. It's our grandparents that even know what that looks like, I'll bring that up if I've got time later on today as the Tweedledum of the week. But it has to do with the crash of 1907 being an example of why the Fed is necessary. And I went, no, that's wrong. It's actually a reason why it's not. But I'll get into that later, like I said, if we have time. We're going to continue the conversation on with that's what I've got as far as the Fidelity paper is concerned. I want to open up back to the Fed. And I'm looking at an article that was published today, actually, by the American Institute for Economic Research. And it's called Death by Inflation or by Interest Rate Hikes. And that was written by Daniel Fernandez of the AIER. That's a horrible number of letters to try to say at the same time. And he goes on to say that inflation is skyrocketing around the world, that inflation is accelerating in Western economies, and core inflation is skyrocketing in Western economies, that the creation of demand by the Fed and some people are going to disagree with this, specifically Joe Carlasari, because I think we had this conversation a few weeks ago, as far as the demand, the increase in prices is more a problem from supply than it is demand. And the question that I have, and actually that this paper has, is that true? Because when you increase demand artificially, which is what stimulus checks did with money that was printed out of nowhere, well, then there's no supply to be had, because the demand that wasn't earned, that was created out of nothing, didn't create anything to purchase. And that's where the problem begins. And that's why you can't say that there's a better economy now, because the demand, which would ordinarily be considered a product of an expanding economy, isn't the case now, because it really has to do with the transfers from the government. And so the demand that we have is artificial, and there's no supply to be had because nobody actually created supply in order to earn the demand monetary unit that we now have in our hands. So that's where this comes up. So here's the big question. Is there anything that the Fed can do, either with inflation or the printing of money or with tax rate hikes, that isn't going to result in a recession the next few months down the road? Who wants to chime in on that one? Anthony, I see your hand is up.
This is actually what I came up for. So apologies on the Fidelity paper because I wasn't quite complete with it. But yeah, so there's a number of ways to address and a number of things that need to be addressed in answering that question. One of which is, what is the Fed's role in the present inflation that we're experiencing? And the second of which is like the whole logistical reality of like what has constituted money printing. To what extent has money been printed, and to what extent will money be extracted, that money be extracted from the system? So I guess I'll address them backwards there. So in terms of what money has been printed, there's really only two ways that money gets printed in the way that we care with respect to inflation. And one is just credit creation by the private banking system. And the second is by deficit spending from the federal government. And in both regards, you know, the credit creation piece, right, is a low single-digit run rate, with the exception of PPP, which was an emergency fiscal measure back in 2020, and then renewed a little bit in 2021. But they deputized the private banks for that. On a going forward basis, you're talking low single-digit rate of credit creation. So that's a rather known quantity. So where else am I going with this? With respect to the fiscal piece, right? Obviously, there was massive fiscal stimulus over the course of the pandemic, right? 2020, early 2021, and then supplemental unemployment insurance up until September last year.
That's what nobody talks about. Nobody talks about the fact that there was a supplemental insurance. What are the $1,200 checks going to do? It's not those. It was the continual $600 checks to those that were just sitting on their couch and not working because nobody can pay people $15 an hour.
Yeah, even then, it's not bluntly like an observable statistic, right? Because it depends partially what people do with that money, and then partially like what offsets. Like with respect to offsets, we actually have, from a fiscal standpoint, which is one half of this equation of what creates money printing with respect to inflation. And even then, it's not that straightforward, and I'll explain that. But on a going forward basis, you're going to have like 8 percentage points worth of fiscal drag this year, just in terms of taxation over and above like credit or money creation in the economy. And
back up a second. Explain that term for me, fiscal drag, for those of us that didn't get through Algebra 3.
Yeah, no sweat. So in the past 2 years, right, we've had a massive fiscal surplus in the sense that they've done all these emergency programs that have essentially put the government in a deficit standpoint. Mm-hmm. And that has created credit in the way, or created money in the way that you and I both mean it, particularly with respect to inflation. And I can talk about that. On a going forward basis, the government is not authorized and has committed to withdrawing that stimulus, not by like any express programs, but by running a budget surplus over the next couple of years. And a lot of this stuff on a year-over-year basis is going to lag to the tune of 8 percentage points of GDP this year. Actually 8.5 percentage points of GDP this year, because they didn't approve the Build Back Better plan, into the tune of 2 to 2.5 percentage points next year. And then in 2024, it's more marginal. It's just shy of 1 percentage point in 2024. So from that perspective, so one half of the balance of what creates money and money supply, it's being massively withdrawn over the course of the next 3 years, really through 2026. The fiscal drag. The second piece of this is credit creation. Like I said, the expectation is that we should have low single-digit growth in credit creation by banks, which are just pretty much private loans. And I'm happy to talk about that and that expectation, but that's like a private market function. So I don't think anybody necessarily has a gripe with that. Now, separate of this, so the fiscal drag is a dynamic piece, right? So like we can obviously look at the amount of money that got printed. Money supply is not the measure of money or monetary velocity. It's not the measure of money that I think any of us are or should be concerned about here. The bigger concern is, when does the available disposable money in the economy, i.e. demand, exceed supply? And this is part of why we've experienced, obviously this is heavily nuanced, right? Like in the housing market, you've had idiosyncratic issues with lumber, you've had, demographic issues with housing supply and stuff like that. That is an idiosyncratic thing. But separate of that, you had the consumption of goods in our economy run about $500 billion over trend throughout the pandemic, mostly because people are at home and clicking the Amazon button.
Right.
And no doubt, part of that was contributed by supplemental and insurance, which I'll talk about a little bit more in a moment. But you also had an offset. 70% of our consumption, and consumption is 70% of this economy. So 70% of that 70% is usually services, and services was running 500 billion under trend, right? So the issue with stay at home and all these kind of pandemic emergency measures that we had was that people were consuming a crap ton of goods. And not only that, the supply chain couldn't handle, nor did it foresee, nor should it have foreseen, at least as late as May or June 2020, nor should it have foreseen that influx of demand. It's pretty much a 20% demand spike for goods consumption.
Isn't that a double-barreled gun, though? Isn't that a double-barreled gun? Let me kind of explain how I see that.
Yeah, sure.
Because the demand was created by the government, and so there wasn't anybody to actually create the supply, which actually partially created the supply shortage. Am I right with that?
Totally. So the biggest thing with that, and that's what I was going to get to with respect to supplemental unemployment insurance, I'm being completely objective with this. You might love or hate Trump. I don't think it matters with this particular issue. Like, the administration, and particularly the Treasury, did a very good job with the first wave of supplemental unemployment insurance in signaling that it was a one-off stimulus, right? And that's an important signal, at least from what we know about fiscal stimulus, because it's a one-off. It hits your bank account, it expires at a set date, and there's not going to be a follow-on there, right? The issue with the supplemental insurance that got renewed, I believe, by Trump in January 2021, and then I think Biden topped it off in March, maybe.
Yeah.
I could be wrong on the dates there. Yeah. The issue with that is when we got to August and September, when that was supposed to be expiring, it was very much viewed as they're going to renew this because we're still in the pandemic. We're still working from home. Delta's been a pain in the ass. Omicron's coming, that kind of stuff. That was an issue, right? Because you would have expected people to flood the job market in August, frankly, in July, if they're rational actors. But there was very much this takeaway that the supplemental unemployment insurance isn't going away. And there's a number of ways that we can look at that. If you look at states that actually withdrew supplemental uninsurance early, like Texas, there was a manifest delta in economic behavior, both in consumption and applications for jobs and stuff like that. So that's like a very important thing with respect to like the spending, right? Separately, it was like the inflation, totally a demand and supply issue. You had a demand shock and a supply shock. And again, these are things that we can test against control groups because you can look at the original wave, the alpha wave of the pandemic, the spike in goods, the shutdown of supply chains from people having to work from home, warehouse workers, transportation truckers, all these kinds of things, many of which were like making that trade-off. Supplemental insurance is a lot better than fucking up my back sitting in a truck all day. Peeing in a can, all that kind of stuff, right? There were rational trade-offs made there as well. But you can also look at the Delta wave, in between the Alpha wave and the Delta wave, the reaction of supply chains to the Delta wave, to the reinstitution of of emergency measures like stay at home. So again, I want to emphasize that it's not directly the money supply is not directly causal for additional things I'm happy to talk about, like the logistics of how money gets printed. It's a function of a number of these things, some of which are going to go away. Others, like housing, we need 8 million houses in the United States at least, and we can only build 1.5 million a year. And you have regulatory issues in places like California, San Francisco, where permits are really hard to come by, stuff like that. A lot of this isn't going to get fixed at the snap of a finger. But some of it, namely that 20% above trend demand spike in goods consumption, getting reallocated towards services, will heal a lot of this. And, just economic reopening in general, supply chains actually getting people out of their homes where you're having issues with, stay at home. And, we kind of know for a breakdown, like the jobs that we lost due to the pandemic, we know for fairly certain from survey data, independent research, government research, why those people are staying at home. Some of them will get fixed. I want to be nuanced here, though. Like, there's a lot of other things like immigration policy, migrant labor, and stuff like that has been a real problem for 10 to 12 years in this country, and it's just gotten worse, and the pandemic made it even worse. And there are these political issues I think we need to solve. That's scarcely a Federal Reserve issue. That's scarcely a monetary policy and money supply issue. Although I think I've been pretty nuanced. Like, there's no doubt that devoid of that monetary policy and that money supply influx, you have to look at the counterfactuals, like what would have happened in the economy otherwise. Plus, on top of it, we're having this fiscal drag that I talked about, budget surplus and stuff like that will be withdrawing a lot of stimulus over the next 3 years. So I'll pause there in case there's any specific questions, because I've rambled for a long time, and I'm happy to drill down on any of these things if you have any questions there.
Actually, I want to thank you for being my impromptu guest. I didn't have one today, and you've been extremely helpful with kind of explaining and going down the rabbit hole with this.
I've been promising Log I'd be back.
Well, I'm glad that you are. So back to my original question is what does you said there are two things, because the Fed faces some issues, but you said it's not just monetary policy. It also has to do with fiscal policy. And so now we've got to go to Capitol Hill and find out what are the things that they have to do and deal with in order to try to avoid a recession in the process of trying to rebalance the economy back to what we had in 2019.
I think that's the important thing, right? Like, it's more Congress and the executive branch that are the primary focus here. Longer term, you have issues like I talked about. Immigration policy couldn't be more important for this country. Like, 50% of our economic growth comes from productivity increases, and the other 50% comes from labor, the growth in the labor force. And of that 50%, that's the growth in the labor force, half of that is net migration to the United States, so immigration minus emigration. The other half just comes from births. So we know what the next 2 generations in this country look like for the most part, but like fertility rates and stuff like that are incredibly low right now, which I guess you could address by fiscal policy too, stuff like childcare and all that. And the pandemic's taken a bite out of that, right? Like, one parent has had to stay home in many households, and that's removed a person from the labor force. So some of this gets fixed naturally. Some of this has to get addressed by Congress, like addressing immigration policy, and all that kind of stuff. I believe that largely answers the question. Maybe I lost my train of thought. Anything else, Nate?
No, we've been going down a few holes here. We may not find our way back to the surface, but that's okay.
Oh,
we're
good. Yeah,
we're good with that.
Yeah.
Actually, to dig down another rabbit hole, though, because I'd asked this question before, a little bit, and maybe it's a little bit not serious, but I think it could be, because it really sounds conspiracy theory generated, but I'll just go ahead and ask it anyway. You talk about fiscal drag, and you talk about the fact that you can't just flip a switch and have the economy automatically react to things that either the Fed does or to what Congress does. And so the question becomes, how long does it take? It's much like a container ship. You got to start turning the wheel, 2 miles before you actually want to start turning. So the question is, how long does it take for that to actually occur? And if a recession is almost imminent based on whether or not we keep inflation going the way it is, or whether we institute the rate hikes, when does recession actually start occurring? Because if I'm right, we're talking about 6 to 9 months. Well, we're talking about getting into 2023 when people start to announce their candidacy or their exploration committees for elections. Does that have? Did they think about that in Washington, or am I just off my rocker here? Am I just going way out?
So that was a number like Ben Bernanke, a number of academics, both within and independent of the Fed. So some of the like regional governors, they've done papers on this. The traditional academic definition is like Federal Reserve policy takes 6 to 9 months to actually trickle through. That's classically, but of course, like, there are so many different factors that go into that can change that, right? Like, you have to make a number of assumptions. Like, right now, the market expects more than 5 rate hikes out of the Fed right now. They expect quantitative tightening and tapering in March, all those kinds of things. Those are the base case expectations. And not only that, like, from a forward-looking basis, the market has already adjusted to that. It's already discounted that. Like, if a bank wants to borrow or needs Fed funds for December this year, they're already borrowing by virtue of like futures at a rate that discounts like 5+ rate hikes this year, right? So like the market mechanism has already fully discounted that at this point in time. So I think that's the first important thing to understand from this. Like tightening has effectively already happened by virtue of the market largely discounting the guidance that the Fed's given at this point in time. Right. So sometimes it takes time for that to trickle through. And like an example of why that might take time is like, maturities from corporate bonds, maturities from small and mid-sized business loans and stuff like that need to occur. And those businesses either need to refinance or roll that debt at the higher rates that are prevailing in the market right now before you see the manifest actually flows of that more expensive money, for lack of a better term. Do you get what I'm saying there? So that can take some time. A lot of these things are known. Among them are like, what does the maturity wall look like for corporates that are borrowers in either the high yield or the investment grade market or the floating rate market, all that kind of stuff. But there are a number of variables that are unknown, right? Like among them are corporations, small, mid-sized businesses, or in particular corporations. How are they going to use their capital allocation? Are they going to choose to either roll debt or take out more debt or a higher cost of debt capital? Or are they going to choose to use their equity, which right now is incredibly expensive, maybe issue equity or whatever in lieu of debt? Those are the decisions that are kind of the unknown knowns. Personally, for me, I think the expectation that we're going to have 5+ rate hikes this year is a bit onerous and a little bit too much. I think there's a lot of reasons why Powell might want to guide to that. In particular, like, there's some stuff with the job market that gets really complicated and convoluted, but I also think there was rampant speculation in financial markets, and he's trying to nip that in the bud. In all likelihood, given that we've had effective tightening done by the market at this point, I think he will follow through with his plans in March, both on the taper and quantitative tightening and rate hike thing. And then I think he'll assess kind of what the landscape is at that point and maybe more explicitly guide the market towards what the expectation should be for the forward 12 months from March.
Let me kind of unpack what I've kind of understood here. At least something that I thought I understood, and tell me if I'm wrong, because I am the professional noob. This is what I do. Basically, when you have a market that the equities market loses value, but that doesn't change the fact that it's been sold for cash. Which does that not mean that there are cash reserves that they're holding on to? And by actually instituting the rate hikes, it makes it more expensive for consumers to borrow that money from those cash reserves. Am I close on that, or am I way off?
So who are they that are holding the cash in your example?
The investors. That would, because they were investing in equities, and now they're not invested in equities. Now that value has been sent somewhere else. Where are they starting that value?
It's a really good question, because that actually gets to the part of my earlier answer that I didn't quite get around to, right? So like cash, an investor selling an equity in exchange for cash does not create new cash in the system. There's an investor out the other side who's buying that equity from them with cash and exchanging the stock for cash. It's a swap. So in terms of the endogenous system, the private market system, that is a swap. There's no new cash created. This goes back to the original at the top. There's only two ways to create new cash as you think of it in the system. One is deficit spending by the federal government, and two is a bank issuing a loan, whether secured or unsecured, is kind of beyond the point. But the credit creation process by the private banking system and fiscal spending, deficit spending in particular by the federal government. By deficit, I mean they're not collecting revenue to offset that spending, right? Does that make sense? So an investor selling an equity does not produce more cash on the sidelines as we classically hear it to be. What creates more cash on the sidelines is those two things I mentioned.
Okay. That changes my perspective on that, because I just thought that one was traded for the other, and it doesn't really change anything, but you're saying that it does. But with because my original thought process was, if the cash reserves are out there and they're not going to be borrowed, then when do people start looking at Bitcoin as a store of value, specifically the institutional investors? Or can they not, because the regulations have been so hefty that they just can't get their money into it?
Yeah, I mean, it's a combination of everything, among them, like the things you talked about. Like right now, regulations are difficult from an opportunity cost perspective for Bitcoin, right? Whether a store of value or a medium of exchange, like Bitcoin is still in its early adopter phase, but like for the mass market, like those value propositions aren't as strong of a pull right now. But again, like Bitcoin adoption is the biggest thing to drive it at this point. Like just going along the adoption curve is the biggest thing. Where we sit right now, you have fiscal tightening, in the U.S. government. You have monetary tightening from the Fed and stuff like that. Like those are negative impulses for Bitcoin, all else being equal, right? So like the biggest thing that drives Bitcoin is like adoption, and like what can stoke adoption. There's a million things, and all these, so like I don't have to go into them, but like if Turkey's currency collapses, that's a huge thing for Bitcoin, right? It's unfortunate for the Turkish people, and this is a hypothetical from the headlines, but like if that were to happen, that's a problem. Nigeria is having issues, Libya is having issues. Those kinds of things are part of what stokes Bitcoin's adoption. But for right now, frankly, nothing else has changed incrementally from August to now. So what you've had is we didn't get Build Back Better, Biden's second prong of his fiscal stimulus. We've gotten Fed tightening a lot sooner than the market back in August had foreseen. And yeah, I mean, like those are the big things. And also like part of Build Back Better and like the package that Biden was supposed to do was supposed to be net stimulative over the short term. And like, we didn't get that, right? So like, those are really what's changed that's created the negative impulse for Bitcoin in the short term. Over the long term, we don't have to go into that. I think we all agree about that, right?
Let me get on the other side of that coin as far as the Build Back Better plan, because on the other side of the aisle, you're saying we really can't afford to deficit spend any more or any faster than we already are. Otherwise, we're going to get to a point where we just can't raise rates ever, because then you're going to cause too much recessionary pressure. Were they right in that regard, or is there value on both sides of the argument, and where is that at?
That's another really good question. That's a very nuanced answer, right? So like, the Fed raising rates won't bankrupt the Treasury in the way that people keep saying, right? So like if the Fed arbitrarily were to raise rates to 20% tomorrow, that'd be problematic for the Treasury, not so much because the Treasury's cost of borrowing goes up as much as it is that it crashes the economy. GDP growth goes down, which is literally income taxes and tax revenue goes down, right? Like that's the mechanism by which raising rates arbitrarily would hurt the standing of the federal government and stuff like that. If you think that, the market and the economy in particular cannot withstand rising rates, and ergo you're saying that the Fed raising rates is arbitrarily tightening, then I'd agree with you. That would be a net negative for the Treasury. And like, furthermore, like the Treasury is relatively unconstrained. This isn't like, I'm not going full born monetarist on you or anything like that, but like, I'm just being like realistic based upon what we know. Like 100 trillion in debt would like be insane. Like that'd be a lot. If we did $100 trillion fiscal stimulus, that'd be insane. But we don't know where the upper limit of what sustainable stimulus is. But what we do know is that money needs to get spent well. Whenever you have a government program, a certain amount of it inextricably is going to be waste and fraud and stuff like that. Like it happens with every government program. It's frankly hard to control for, and it happens. But if that is malinvestment, right? If the U.S. government were to go out and I'm trying to think of a hypothetical, invest in solar panels that are only 10% efficient instead of like the 95% efficiency that you have in the prevailing market right now. That'd be a really crappy investment, right? Like you get a bad ROI on that dollar. That'd be problematic for the federal government because the return on those dollars would be a lot lower. The tax revenue off of those dollars spent in those projects would be a lot lower just because they're obsolete before they even started the project, right? So from that perspective, fiscal stimulus is risky because like, do we trust the government to be a better venture capitalist than a venture capitalist or the private sector or something like that, which is often why the federal government tries to, as a principle, lean on the private sector to allocate that. But of course, that comes with its strings and its challenges, right? But just, again, to review and circle back to your precise question, the Fed raising rates to 2% could predicate a recession. I believe it's likely that it would predicate a recession. The Fed would then just have to loosen policy again. They'd probably have to go back to quantitative easing again. Inarguable, I wouldn't think at that point in time, considering or assuming that COVID's over, the economy's reopened, I wouldn't think fiscal stimulus would be necessary or advisable, because I don't think those are emergency measures. I think those are garden variety recessions, all that kind of stuff. But the point here is that the Fed's attempt is to match the natural rate of interest with the rate of interest that the economy demands from a supply and demand standpoint. Do you get me? Any less of that, you're creating either unnecessary inflation or unnecessary speculation, excesses. Any more than that, then you're literally choking off the economy, credit creation, business formation, those kinds of things. So it's a very difficult task for the Fed. They try to balance it. They're human. Some of them are bad people. There's no doubt. The majority of them are good people. This is social science. It's not science, so or natural science or anything like that. So this is all the kind of crap they have to deal with, and politicians have to deal with out the other side as well. So I guess in sum, you get the answer to your question.
I think you have. I think the main concern that I have, and I think it's shared by other people, is that it's a heck of a lot. There's a lot more power in raising 25 basis points from, a 0%, yield than it is to raise it 25 basis points from 4.75 to 5%. And it would have been a heck of a lot.
Yeah, one's an infinite percent raise, and the other is like, I can't do the math, but 25 beeps on 4%. Yeah.
I think that's why the Federal Reserve has such a hard time. Well, both the monetary and the fiscal side, they're going to have a very difficult time trying to manage this tightrope when they've got either zero yields or net negative yields that they're dealing with. And isn't you say we don't know when we get to the end? Well, isn't that signal that tells us we're getting close to the end when we're starting to have zero yield, and you have to start printing money in order to make sure that the economy keeps going, because you can't do anything else. You can't cut rates anymore. You're getting down to nothing.
You're nailing it. You're asking all the right questions, but this gets back to the natural rate of interest demanded by the economy. The natural rate of interest demanded by this economy is at or near zero. I mean, Europe, it's negative. Japan, it's negative. There are reasons for that, right? There are reasons for that beyond some government scheme to disinflate interest rates over the course of 30 or 40 years, all the way towards zero. I mean, part and parcel with this is like our demographics in this country, in the United States, peaked with the baby boom and the post-baby boom in the 70s, the 60s and 70s, right? So this gets back to what drives economic growth in this country. Two factors: productivity, which has been awful for the last 20 years, and population growth, which was supposed to be splendid right now by virtue of the millennials being the biggest demographic the world has ever seen. But that is being chewed away at by the thing that we thought we'd never have to worry about, which is net migration, right? The U.S. is a place that people want to be, and all that, this, that, and the other thing, right? Like, that's been a problem going back to the top of our conversation. The upshot of both those things, of our population growth being below a single-digit % a year, and productivity growth being at or near flat, is just demanding, interest rates that match the natural growth of the economy, which is at or near zero, right? That's pretty much where we're at. So what changes that in the bet that you're making, right? Particularly if you're a nihilist, or if you're, an uber bear on the future of the United States, the US dollar, US assets, anything like that. What changes that? I mean, you have to make a bet on those two factors, right? Like population growth, in particular, immigration policy, and productivity growth. I would argue that the productivity growth aspect of this is less of a concern at this point. I think we're starting to reach a realization phase for a lot of the seeds that got planted over the last 20 years. I think we're starting to harvest a lot of those and make our businesses more efficient. There are regulatory hurdles to a lot of that. Like, you have to reallocate a lot of the labor that gets obsoleted, and you might be bearish on that. And I think I'm kind of bearish on that as well. The ability to reallocate human labor, human capital towards more productive enterprise that's less obsolete. So I totally get why people would be bearish, but those are the two things we should be talking in context of, like productivity growth and all that. Now, countervailing all this, I've just been talking about the U.S. You have like the external sector too, which is incredibly important to the U.S., right? Externally, what do you have? You have incredibly awful demographics in Europe. You have worse demographics in Japan, and China crested on its demographic tailwind, I think 2 years ago. Chinese population is contracting in terms of prime labor force growth, which is really the only demographic that matters for this analysis. Offsetting that, more than offsetting that, is the United States, in particular India and Nigeria, and much of South America, who have positive demographic tailwinds. Net, the issue is, if you add those all up, the population growth that you're seeing out of India, the United States and South America and Nigeria, is low per capita income population growth that will rally in coming years. Just like China rallied, you'll have this rising middle class and stuff like that in a lot of those geographies. The U.S. is obviously the exception as one of the wealthiest nations in the world. But the offset that I talked about in terms of pure population, like headcount, right, number of people, Europe, Japan, these are wealthy populations. China, at this point in the game, median income times the number of people there, is a relatively wealthy nation in terms of its contribution to world GDP and GDP and income available to the United States. And then we all know when the U.S. sneezes, everybody else catches a cold, kind of a thing. So that's kind of the issue, and that's what you're making the bet on, right? Like, it all unwinds, I think incontrovertibly unwinds over the long term if you're unable to wring growth out of population and productivity without one offsetting the other. Humans throughout time have been incredibly inventive and a ton of ingenuity in making that productivity growth make up for what they lack in capital formation, meaning like human labor formation. Productivity throughout history, whether it's in a recession, coming out of recession, stuff like that, wartime, productivity has totally surged to fill the gap. So I think it's a tough bet to bet against that productivity surge. But again, I'm trying to be nuanced in my answers. Like, I really, truly think that, like, these are very difficult questions, and the odds aren't 90% that the U.S. is going to grow out of this. Like, it's far closer to 50 than it is to 100,
Right. And I appreciate that. And your answers and your explanations is exactly why I did not get into economics. So thank you for actually getting into that for us, so that I don't have to worry about.
Things are not deterministic. They're not deterministic. They're probabilistic and incredibly complex adaptive systems, so.
There have been some requests and they've gone away as we've gone, because I know that we've been kind of having this conversation back and forth. But if you have a question for Anthony Bardaro, who's become my impromptu guest on economics and the Fed and what the future holds over the next few months, then by all means make a request, and Log can get you up on the stage while I take this short break. Hey, if you're listening to a replay of this episode of The Bitcoin Effect on YouTube, Spotify, or Apple Podcast, then hey, thanks for joining us. Consider leaving us a comment or a review saying you'd like to hear more of what we're doing here. It helps us out a lot, and it also helps others who don't know much about Bitcoin to discover the program. If you want to join the conversation, make sure to join me every Tuesday at 3 p.m. Eastern, 12 noon Pacific on Twitter Spaces. Visit thebitcoinspot.net and click the link to follow at the Bitcoin Spot to watch for the link in your feed. I noticed that I do have a request. Luke, I will get you up here in just a second. But again, I want to thank Anthony Bardaro for kind of becoming my impromptu interview guest and really digging deep into what variables go into the decisions that need to be made, both at the Fed level and also at the congressional level. So I want to thank you for that. Luke, you're now on the stage. Do you have a question for Anthony?
Yeah, I missed the first part of that conversation. What are we talking about the US outgrowing and it being a 50% chance? We're not talking about the debt, are we?
No, well, kind of indirectly, but more so, is the U.S. going to suffer a total growth collapse by virtue of the population collapse? Like, we're already, a growing population far below trend. So things are positive, which is fine, which is good and fine. But the question is productivity growth going to accelerate to offset whatever decelerating population growth we're going to have, or are we going to turn completely negative in growth? And that would be problematic from a number of perspectives. Debt is part and parcel with that, I suppose. Like if you have imprudent fiscal spending, like not emergency fiscal spending, imprudent fiscal spending just to prop up GDP. And we were talking about if we were to go into a recession next year, a garden variety recession, so not a pandemic, not a complete in total credit crisis like we had in 2008 and 9, and you were to fiscally stimulate in a meaningful way, that would probably be money poorly spent in contrast to this. So we were less talking about outgrowing the debt, and we were more talking about just organic GDP growth as a function of population growth and productivity growth turning meaningfully negative, and the future expectations of that turning meaningfully negative as well.
Yeah, I think a lot of the Western world's going to continue that trend. And I think as you industrialize the developing world, their population is going to do a very similar thing. It's going to slow down and start to actually decline. But I think if you actually look at a chart of GDP growth and the way they used to measure it, so again, go to shadow stats, don't measure inflation using the government official CPI basket, go to shadow stats and look at the way the governments used to measure it 20 years ago before they fucked around with the metrics. If you look at the GDP chart, so the unfucked chart from shadow stats, actually shows we've been in a recession for the past 10 to 15 years. I think, what's his name? Jeff Snyder and Emil Canal, I can't pronounce his last name, but they call it the silent depression the past 12 to 13 years because we've already really been experiencing negative GDP growth. Central banks have just been kind of playing a charade and saying, oh, no, look at our manipulated GDP growth chart. Well, look, we're growing, everything's all good. Let us keep printing money and extracting wealth from the lower and the middle class of the economy and boost these asset prices higher. It's all good. So I just expect that to get worse, and I think eventually it's going to, like you've identified the problem. You can't have declining population growth in an inflationary monetary system when the rest of everything around the world is deflationary, whether it's technology, demographics, everything's deflationary. You need deflationary money to boost, and that's big.
That was what we were talking about. And I know, like, Luke, you and I have talked before, right? So I know you don't necessarily have to answer this, but you can have declining population growth. You need to make up for that with productivity. Throughout history, not on an annual basis, but on a decade-long basis, like humanity has made up from a shortage of labor capital with productivity gains. It's just like we're an incredibly inventive and a ton of ingenuity among our race, right? Like we find a way. That all said, no guarantee we're going to find a way going forward. I'd argue that we have the raw materials at this point in time between technology, among it crypto and stuff like that, in Bitcoin in particular. I'd argue that we have the raw materials to produce a productivity boom. But as to whether or not that happens, I mean, it's not a deterministic thing, right? Like we're betting on probabilities.
Yeah, the probability is pretty low. I think I was looking at a chart of GDP growth a while ago, and over the past 180 years, we've never had GDP growth above 10 or 11% for more than a year or two on end. And for us to actually outgrow a debt to GDP debt balloon of 400%, you're going to actually need sustained growth of well north of 10 and 15% for a long, long time. So I think the probabilities aren't great.
Luke, what is the governmental impact? How does the government impact the GDP growth? I mean, obviously, when you add corporate taxes and you add regulation, then you put a squelch on that. So is it necessary for that to kind of reverse so that the markets can do what they're supposed to do and actually create more productivity?
I mean, that helps. Printing money helps the GDP number as well, which is what they all love to do.
Well, yeah, but that changes the distance between inches on the measuring stick too.
Exactly. It's all a charade. All government metrics are a charade. CPI, GDP, all of it.
Enter Bitcoin, which keeps the inches the same distance apart from each other. And obviously, there's a lot of people that would say, well, we still need the Fed and we still need a governmental, basically manipulated money in order to make sure that these aren't these huge downturns or huge swings in the economy. What do you say to those people that still think that kind of manipulation or that kind of cushioning is still necessary, when we have Bitcoin and a hard money available to us?
I'll post one chart in the nest. I'll give us 30 seconds to grab it and post it to Twitter and put it in here. But you can see since the creation of the central banks and the Fed in 1913, and once they took us off a gold standard, they've actually increased the volatility in the markets. Their claim to fame of price stability is an absolute lie. If you also look at a 400-year of CPI inflation, you can see that the CPI is relatively flat for 300 years you're on a gold standard. And then as soon as the central banks come in, CPI absolutely explodes over the past 100 years. Central banking are the ones who create the volatility. They think by stepping in and printing money in the short term, they're smoothing the business cycle. But what they're actually doing is you can't take volatility out of the markets. You can only mute it in the short term. And the more that you step in and mute volatility in the short term, the more it builds up behind the curtains. And when it finally rears its head, it's absolutely massive and bigger than it had been in the first place.
Anthony, agree, disagree? Something you want to hop on as far as his points?
I think it really comes down to, like, risk cannot be created or destroyed. It can just be transformed, in the sense that, like, if you choose to be on a gold standard or a Bitcoin standard, right? Like, you're controlling for one variable, less so in a gold standard, which is part of why I think Bitcoin's superior, right? Like, gold mining is a completely arbitrary creation of or destruction of supply relative to what the underlying economy demands. At least Bitcoin's fixed, so you're controlling for supply. I think that's preferable to an arbitrary gold standard, which I call a basis risk in the creation or mining arbitrary of the underlying economy. But if you control for supply in a way that Bitcoin does, right, you're choosing to let a couple other variables free float, variables that the Fed, in its best estimation, has tried to control, right? One of those variables is liquidity, right? And credit creation and, like, massive deflation. So you're going to have to go through a massive deflationary event to transfer to a Bitcoin standard. This is kind of why I prefer Bitcoin, and I really think the end state of Bitcoin is going to be as a sort of third estate for money, in the sense that it gives the people this radical demand side opportunity to have a voice in politics and policy and stuff like that they never had before. Happy to delve into that. But for the developed world, in particular, US, Canada, Europe, Japan, all these, Australia, things like that, you do have this edifice of credit. And I think it's the worst except for all the other alternatives, right? So to transition to a Bitcoin standard, unless you're going to have credit creation on L2 or L3 or something like that on a Bitcoin standard, in which case I'd ask you, like, what's different, right? Like, you're creating this private credit impulse that's no different than the status quo. You're going to have to just completely eradicate a ton of credit. That credit is both a liability and an asset. So you're really just imploding that system upon itself. So what happens when somebody wants to create a new business, right, from scratch? A college kid just graduates, a high school kid wants to start a new business. They have no money. They don't have an apartment. They've got nothing. Credit is what allows somebody to make that bet on themselves and pick themselves up by the bootstraps, right? If you eliminate that, then you eliminate growth, innovation, all those kinds of things. I think it remains to be answered, and I think it will get answered over the long term, how these things can coexist with each other. But for the time being, like, my expectation is Bitcoin provides that third estate, classically speaking, if that all makes sense.
Yeah, that makes sense. I 100% agree on the point that you're going to see a massive deleverage in the debt market right now. Like, you've got a $400 trillion debt market. That's naturally going to have to deleverage if you're going to transition to an equity-based society. So I agree with you on that point. And then I think the point about debt on a Bitcoin standard, I don't have really, really strong opinions on how that's going to look. I think it's going to be a lot less than what it is today. I don't know who's going to facilitate that at what rates. But I think it'd be interesting. My kind of very loosely held opinion on debt is, instead of looking at a $400 trillion debt market today, I think it might look something like, maybe 40 to 50 trillion of debt worldwide. So I think it's going to decrease by 90%. And I think the only people who are going to actually get access to capital are the people that you're talking about, Anthony, the ones who are interested in productive business ventures. Because I think if you have a look at what portion of that $400 trillion of debt is productive, Jesus, I reckon over 80% of it's just malinvestment and companies buying back their own shares and fucking all the cronists and the Cantillon and the Cantillions give themselves 0.1% loans to go and speculate on XYZ stock. Sorry, I'd opened the door for someone to come in then, so I missed the second half of what you were saying.
That's okay. Drew
no, it's all good.
Drew just came up onto the stage. You have something to add or to ask, sir?
I'll hold. I'm enjoying the conversation as is. But if there's a lull, I always have something to add.
All right, Anthony, you had a thought. Continue.
No, I'm good. I was just saying peace to Luke and Drew. I'm good. That wasn't a hand raise. No, I mean, I think Luke and I are in complete agreement, right? Like the thing I think is reasonable to disagree on, although to the tune of it, I think it's hard to disagree, right? So if you're going from 400 trillion to 50 or 90 trillion in debt, right? Let's just say you're cutting debt by 80% or 70% or whatever it is, right? Like that debt is an asset. That asset needs to get written down. The way that you can digest that debt deflation is by growth, right? Like, so you could outgrow it. So like the real question is, I believe, is there a real economic productivity that's wrought from Bitcoin that can displace 300, whatever that is, $320 billion or $1 trillion worth of debt deflation? I'm not entirely convinced that's the case. I am convinced that for like today, and in particular in 5 years, when like internet infrastructure and stuff like that has been built out in much more of the developed world, for emerging markets and for the unbanked in much of the world, I think it is a meaningful productivity enhancement. I don't think even, taking into account all of that and the economic uplift and the economic multiplier that comes from that economic uplift, I don't think there's $320 trillion worth of new productivity to be wrought from that. But I do think over a 100-year time frame, it'll be incredible to watch the creep of that. And like maybe we will slowly deflate that away because there are some properties of this that unlock economic potential and stuff like that. I can assure you that like sound money is not one of them though, right? I agree on the fixed supply is a value, mostly because that third estate thing I talked about. Sound money is not going to be your avenue toward that 320 trillion of debt displacement in incremental growth, like new growth, in other words, from the unlock. But I don't know. I think I've covered it all.
Yeah, I love your optimism. You go, Nate.
Go ahead. You had a thought. Go ahead and run with it.
No, I was just going to say I love your optimistic take. And I'm not like I don't know. I think there's probably, if I had to stick a probability on it, there's probably a 70 to 80% probability that the transition to a Bitcoin standard's probably going to happen faster and more violently than most of us want. So that's why most of the times when I'm talking about the $400 trillion debt bomb, I see it going down in a pretty violent manner over the next decade. But I like your optimistic approach. I'm not ruling it out that maybe Bitcoin can slowly grow alongside that $400 trillion debt bomb and we can kind of slowly deleverage it. I like that idea. I really do. That's actually... I haven't given that enough thought as I could. And I do see Bitcoin as a really big technical revolution that's going to change society. I think it's obviously so much bigger than the Industrial Revolution in the 18th century. It's so much bigger than the Steel Revolution that came 50 years after that. It's bigger than the automation revolution in the early 20th century, and obviously the telecommunication one in the 1970s. So I obviously think it's going to unlock more potential than those five revolutions we've seen. But all of those revolutions didn't really give you GDP growth much bigger than, that 10 to 15% that I was talking about earlier. So I think
why is more than 10 to 15% so important to you? Is it because of debt levels?
Yeah, that's the number you need to actually outpace
Okay.
the debt. I've done some maths on that as well, and I can link it in the chat up above. I posted the chart of the 200-year Dow Gold ratio, and you can see since the central banks were created in the early 20th century, volatility just absolutely increased. And you can see the 100 years prior, when you're on a gold standard, the volatility remains in this really kind of tight band, and markets are relatively stable, and price stability is not really much of an issue. And then central banks step in and boom. But I'll pop a link in here about the maths I did on the $400 trillion debt bomb.
No, I feel you. I mean, that's a good metric. I mean, I think one of the important things though, Luke, and again, I'm not going monetarist. I'm not like a full Keynesian or MMTer. Like I'm not even close. I think I'm far closer to the middle. But the issue, whether you're looking at a corporation or the federal government, right, or the U.S. government, I should say, is the debt two things in particular. One is the debt doesn't have to get repaid in entirety tomorrow, right? So like the debt continually gets rolled. And in particular, if you're under the assumption of like any kind of economic growth at all, or not sustained economic contraction, then that's not a material problem. And the second part of this balance, which I think is the more important thing, because like, again, that the first thing I just mentioned rely on a number of assumptions, many of which like, I think all of us will disagree with one another on. But the second is like, you know, the US government is not a household, but if it were a household, like we're only valuing it on debt to income, like the debt to assets of the United States are like insane, right? Like this is one of the reasons why I think there was a book called like The Accidental Superpower, and I think the main premise of it was just like, holy hell, like America really stumbled ass backwards into like one of the all-time greatest circumstances ever. I mean, just by virtue of our natural resources, of like strategically our borders and stuff like that. Like it's an incredibly well-endowed country from a number of reasons, right? So like on a debt to assets basis, the U.S. is nowhere near insolvent or illiquid, mostly because of the productive capacity can reap just like endogenously from inside of its own borders, you know? So it doesn't need the external sector from an import standpoint as much as it actually uses it. Like it can be a fully closed economy if you want it. Of course, the greatest good for everyone is that it's an open economy, including the US for a number of like strategic reasons, but also like just for purely like geopolitical ones. But it's a really well endowed country. Do you follow? So like this is part of why I don't think it's necessary to deflate. Of course, we all want bad debt to get expunged from the system. How much bad debt is there? It's a difficult exercise, but probably 15 to 20%. And of that 15 to 20%, a quarter to a half of it will just get extinguished, like just by pure defaults and bankruptcies and stuff like that, you know, particularly in emerging markets, particularly in the corporate sector and stuff like that. So some of it takes care of itself. And then, of course, you know, we've had two events in the last 20 years that I would estimate are emergency conditions, non-garden variety conditions. And I guess we can debate the responses to those and like the debt that was taken on to support the system from that. But anyway, the other thing, Luke, is if we do get 20% growth, whether it's predicated by the status quo system in fiat or it's predicated by Bitcoin, the natural impulse is to leverage that growth, right? Like whoever you are, if the prevailing rate is 20%, right, and you can leverage that 1 times and get 40%, then that's what people do, right? So like this is part of why I say whether you do credit creation on L2 or L3 or on the mainnet somehow as like a stack or something like that, you're contending with much of the same issues, like with all these things, whether it's encryption or like computer science or finance or whatever it might be, the weakest chain in the link is always humans, right?
I was going to ask that question. I was going to ask that question, Anthony, is that, you know, as we have this 20% growth, this temptation to leverage that growth to try to grow that much more, doesn't that just exacerbate the problem of the more credit that we're actually trying to eat up already? It seems to be this vicious circle.
Yeah, I agree with that. I thought that the whole thing was to get away from like reserve banking or fractional reserve banking.
Yeah, Bitcoin is the great definancialization. We don't want to recreate the current system on layer 2 and layer 3 of unabated credit creation that's used on unproductive resources and ventures. Like Bitcoin fixes all of this crap. We don't want to recreate it. And I think that estimate of 25 to 30% of the debt being unproductive is awfully optimistic, Anthony. I think if you have a look at the long-term trend of house prices compared to incomes, if you have a look at just the average house compared to the average income, only 50 to 60 years ago in the 1960s and 70s, while we were still on a kind of quasi gold standard, you can see that the average kind of price of a home is 2 to 3x your average man's income. And today, in most places around the world, that's blown out to like 10, 11, 12 times multiples. In some places in Hong Kong, it's like 25x.
Yeah.
The average. Like that kind of shows that the $350 trillion real estate market is pretty overblown and 80 to 90% larger of kind of what I think it will be on a Bitcoin standard.
Yeah. So a couple of things, Nate. Like, let's talk narrowly about the housing thing, Luke. And if Nate wants to go down this rabbit hole, because this seems like really polished, and I think Nate had a direction he wanted to take this, so I don't want to monopolize it. But Luke, I think there is something that, like, you and I, since we've talked together so much in these spaces, I really do think there's a problem that you and I should be working on together. This whole community should be working on that. Like, maybe we can start chipping away at today, just like starting to solve for these things. But like with the home ownership thing or with the home price thing, right? 65% of Americans own their own home, right? 10% of the housing stock, less, like 7% of the housing stock turns over in a year, and that includes new homes. So for the vast majority of people, an increase in house prices is a beneficial thing, right? So I'm not arguing that there's not home price inflation or shelter inflation. Like, it's significant right now for reasons I was talking about, Luke, before you got here. It's a number of things coalescing at the same time. One of these is demographics, just like the sheer volume, the girth of the millennial generation that, is starting, the biological clock's ticking. They're having babies, just like the generations before them. Every generation starts out anti-establishment, and then they all conform, right? So like the millennials are doing it too. They're forming households, and we need 8 million houses for them. And we can only build 1.5 million a year, in inventories at record lows, right? Like, there's just nothing you can do about that supply-demand imbalance other than build new homes, which is a regulatory issue in many of these localities more than anything else. There are some innovative things you can do, like building tiny homes, I suppose, 3D printing homes, all that kind of stuff that wouldn't hurt. We kind of need to shit or get off the pot with some of that stuff. But like, you've also had other stuff thrown at it, right? Like the pandemic taking people out of the labor force for the express reason that they didn't want to get sick, whether or not that was wise. That's a reality. Like 2.5 million people aren't in the labor force today because they're afraid of getting COVID. Hopefully some of that heals itself. Migrant labor issue, which hurts construction as well, which is a political issue, not a Fed issue. And then like a lumber issue, right? Like Canada putting quotas on its forests, and that's where all of our lumber comes from, because the lumber we get from the southern United States is too soft to use for home building. So all of our lumber comes from Canada. Back in 2020, they had a really warm winter, 2020 to 2021. The beetles that like naturally prey on these trees didn't die, and like they ravaged a lot of forests. Plus Canada had export quotas or caps on exports of lumber. So just like everything hit housing all at once, right? So there's all that kind of stuff. So, beyond that, I do think like the most constructive thing we can maybe talk about here, Luke, is like this credit issue, right? Because like we talked about, a young kid who's getting started in life, whether they're educated or not, you have the 0 to 1 kind of issue for that kind of person, the chicken or the egg issue. How do they rent an apartment? How do they start a business? How do they get a job? How do they have sustenance? Unless they have well-endowed parents, right? Like what is that cold start problem? And the solution is credit to date for that. So I think there's a real question, like, how does that work in a Bitcoin standard, and how does Bitcoin improve the credit process? I still think the human is the greatest weakness here, right? Like you need forecasting abilities to apportion credit wisely, right? You can definitely apportion credit stupidly. There are a number of ways to do that. But to do it wisely is a very difficult thing, right?
And I think that that's been the big question is, and I think that you're both kind of trying to get to the answers. Unfortunately, it's going to take more of us and more time than what we have during this conversation, because as you tighten credit, necessarily you're going to have to put a premium on what you're going to invest in productivity. And actually, Anthony, you came up with a great point, which is, how do kids that don't have a wealthy family or assets, how does a kid get started without having access to some sort of ability to borrow money, or at least to owe somebody something for the privilege of living in their house or eating food or getting an education? What happens with student funding? Henry's been on the stage waiting patiently to be able to comment on this. Welcome to the stage, Henry. What do you got?
Thanks, Nate. I just wanted to share some personal views on this topic of credit and economics. I think that, I've heard a couple statements here and there in this fascinating conversation where, someone has said that credit is not so good. We want to get away from credit. And I wanted to provide some critique of that line of thinking, which I think we should acknowledge comes from some of the remarks that Satoshi wrote. He wrote criticisms in some sentences against central banking, but also he wrote that banks lend out money with barely a fraction in reserve. So this Rothbardian view that full reserve banking is best is common within Bitcoin thought. However, I think there's a lot of value in the opposition in the other side of the Austrian school that argues that competitive free banking has endogenous stability and facilitates a reduction in the cost of the payment system by creating money without a corresponding increase in the resources expended on mining. Whether you're talking about Bitcoin mining or gold mining, the concept still applies that an increase in total purchasing power through the fractional reserve increase in ledger entries at banks increases the amount of money held by the consumers effectively, even though there isn't more ASIC machines being built. And credit broadly is a free market phenomenon, a discovery, a technology that facilitates financial intermediation between borrowers and savers. There's nothing wrong with credit per se. I think some of this anti-credit thinking is a simplistic response to the Keynesian incorrect emphasis on credit and spending as the wellspring of prosperity, when in fact savings and production is the wellspring of prosperity, but credit as a mutually beneficial intermediation between borrowers and savers, often facilitated by a professional custodian, as Anthony rightly talked about, a speculator, an entrepreneur trying to find good credit at attractive terms that are appropriate in terms of the credit worthiness involved, the time preference of the parties involved, and the expectation of deflation or inflation is the third component in the interest rate involved. So I think there's nothing wrong with credit, and even more specifically and more controversially, fractional reserve banking. It's the central bank, which is a phenomenon that comes into existence through violence or the threat of violence, confiscation, and prohibition. That is where we depart from the free market. That is where the central planning begins. Central banking. It's not competitive free banking. That's the problem. It's not consumer choice. It's central banking. That's the issue here that we should oppose, in my opinion.
That's really well said, Henry. I part of this is this gets to what's so fascinating about Bitcoin, financial access and stuff like that. You can one of the criticisms of Bitcoin is obviously the energy intensity of it. And it's really what's the energy intensity of traditional finance? I don't know. I don't think anyone really knows, but I promise you it's greater, per unit of output than Bitcoin is.
I'm certain there's more nuclear power going to that than there is to Bitcoin.
Yeah. Yeah, it's true. And on top of that, one of the best things it can do, right? There's a fair amount of redundancy and overhead associated with traditional finance. And a lot of that is inextricable. A lot of that shouldn't and won't go away. But for the stuff that doesn't require that, Bitcoin eliminates a lot of those redundancies and just the trustness protocol that it is and all that kind of stuff. I think that's the hugest thing. Henry, the one point I agree with, I think everything you said. There was one thing I so the Federal Reserve, Jekyll Island, all these kinds of things. about the Federal Reserve. And I mean, I've talked about it, like the humans are the weakness in all of this, whether it's Fed governors, whether it's consumers, whether it's businesses, like whatever you might have, right? At the end of the day, if you're just taking care of transactions, right? If you're just taking care of transfers, money getting from peer to peer, huge. But whenever you have the credit creation aspect of this, there is inexorably going to be defaults in the unforeseen, right? Like you're quite literally forecasting future growth in production and creditworthiness when you're extending these loans. The purpose of the Fed, as opposed to like a number of just private sector banks operating independently, is if you have a collapse in Bank A, Bank B doesn't go under by association, or consumer Z of Bank A doesn't go under because their bank went under. The Fed is the lender of last resort. Now, I completely agree that that's been perverted, right? And I completely agree that in 2008 and 9, a number of people probably should have gone to jail that didn't. And so there was deterrence that didn't occur in 2008 and 9 that probably should have, and all those kinds of things, right? But at the end of the day, the Fed is a pure construct, just like fractional reserve banking makes a ton of sense. And what the function it performs makes a ton of sense, right? Like, as for if there's corruption in the Fed and you know about it, I'm not going to avow that, right? Like, I will disavow that undoubtedly. And I'm sure you can find some articles about like someone inside the Fed, insider trading. And I completely agree with you that shouldn't happen and all that kind of stuff. But as a pure construct, as a lender of last resort, to assure that, if your bank goes under or your landlord's bank goes under, you don't lose your housing, that kind of a thing, by no fault of your own. I'm okay with that, clearing mechanism. And again, I don't avow anything in 2008-9. Like, there should have been more of a clearing mechanism than there was. Does that make sense, Henry?
To me, respectfully, no, it doesn't. To me, respectfully, the Fed definitely is not part of the free market. And a lender of last resort is absolutely not part of a competitive banking sector. The banking sector, no different than the healthcare, education, transportation, and other sectors, other than perhaps police and national defense, does not require a central government licensed monopolist that is protected by legal tender laws and unlimited inflation power, which also, practically speaking, not logically, but practically, will finance the welfare warfare state, causing an excessive amount of unlimited government.
Yeah. I want to let the Bledge chime in on this. What have you to add or to ask?
Sure.
Hey, thank you so much for letting me come up and speak. I joined this space not too long ago and hopped right into a conversation I find very interesting. So I apologize if I brought up something that you might have had already discussed and tackled. But I think that when you're talking about credit markets, you're talking about just capitalization in general. And I really look at in a Bitcoin world and in a Bitcoin economy, that while I do agree that a free competitive banking system would be much better than the system that we have now, I still believe that
Agreed, definitely.
I think the best opportunity for us to utilize to create the type of economy that Bitcoin can create is way more about creating equity and looking at capitalizing local businesses, at least, with the idea of creating a large web of diversified portfolios of equity. And to me, it's the fastest way to create a sustainable form of monetary velocity that is a balancing factor against inflation. And I think when you establish that first, you're going to create you're creating a secure economy because money is flowing without any sort of debt that's kind of like slowing it down. And with that, you create the foundation for a healthy, less risky credit market. So my belief is that, especially during this sort of transitional period into like a hyper Bitcoinized world, if that's the discussion, deflation is going to happen so rapidly that any kind of credit, it would be just risky for both parties. And, people are going to be holding and sitting on money that they could use to create a cash flow. And
Anthony, I'll let you respond to that, but I want to get Jal on as a speaker, but then Anthony, I'll have you go ahead and respond to that.
Yeah. I actually. Oh, were you telling me or Joe? Okay, go ahead.
Yeah,
I'll mute.
let Jal go first, and then I'll let you respond to the
Sure,
Ledge on that.
Sure.
Jal, welcome in.
Okay, I'll try and keep it on the same topic too then. So when we're talking about free banking in regard to Bitcoin, it's basically a reference to George Selgin through Hal Finney, who talked about how Bitcoin-backed banks would exist. So be curious to know who here is familiar with that works. And basically the premise to Selgin's inquiry is that there's no monopoly issuer on the base currency or the base money, which is sort of thought of as like gold on a gold standard. From a national view, we don't have this free banking, but from an international view, especially with Bitcoin, there is no monopoly issuer on the supply of money. So we do have what Selgin would describe as a free banking environment.
Anthony?
Yeah, I mean, that's largely, I largely agree with Joel. I think Joel, myself, anyone else up here can probably poke holes in part of that, but like for the majority of use cases in aggregate, I think that's correct. And that's essentially what I was saying, but like credit creation is a private banking process, right? Like each bank independently makes its determination whether or not it wants to create credit by extending a loan. So there's that. Separately, I think the Bledge and Henry were like two really apt points, and I actually agree with more of that than it might sound. Like I agree with almost all of it. The issue, and I think they make kind of opposite points, right? Like the Bledge was kind of talking about creating these localized economies, and Henry was talking about no lender of last resort. In the common thread through two of those were actually what I was going to respond to Henry with is that devoid of a lender of last resort, and maybe this is desirable to you, right? And if it is, then so be a difference of opinions, but like devoid of that lender of last resort, historically, the way it's worked is, Panic of 1907, what happens if you don't have a lender of last resort? The system gets saved by a private actor. And there are fierce economies of scale there when a JP Morgan the man steps in to save the system. He ends up aggregating essentially monopoly stakes across the entire economy. Like ergo, the guy's got a massive marginal propensity to save, has huge savings, huge investment capacity. And, in the case where you have a panic without a lender of last resort, who's going to be available to step in there and save the system? It will always be the wealthy, right? Just by virtue of their marginal propensity to save versus consume, right? Like everybody else is just trying to get by in a panic. They're just trying to buy groceries and shelter and stuff like that. Like it's the wealthy who have the money available, and then they end up making the emergency loans. They get crammed up to equity, or they make equity injections, and they end up owning, from a trust perspective and a monopoly perspective, much of the economy, right? So I think that's one of the issues. And then on the other side of the balance, again, like I agree with much of all of your sentiments, but like this is again where like the human aspect of it becomes the fly in the ointment. Like with the locality thing, it's similarly a regulatory issue, right? Like people are not going to choose. Of course, it's a broad market, right? Like it's a huge marketplace. Some people choose, myself included, choose to consume locally. If all else being equal, I choose to go to the local shop instead of a Walmart, kind of a thing, right? But in aggregate, in particular for the mass market, in particular for the majority of dollars spent, there are huge economies of scale, and there is a huge cost advantage in consuming, like from economies of scale, from corporations, from multinationals and stuff like that, which is the issue with localization, right? Bitcoin doesn't necessarily solve that. You could paint the picture of a future in which Bitcoin would solve that. My question is that the probabilistic state, and how do we get there? But I think your two responses are actually opposite ends of the same coin. Like this all requires regulation, which is essentially the form that the Fed's taking. And again, I disavow a lot of what's happened. And I do think that the pendulum swung too far to one extreme in terms of a number of things: regulatory capture, moral hazard, all those kinds of things. Anyway, go ahead, the Blodge.
Yeah, I mean, my response to that is I think like the natural game theory, again, moving from where we are now to where we can end up is going to really put a massive amount of, it's going to put a high necessity for high interest rates on all types of credit. And I just don't see that like there's gonna, like you said it, like there's gonna be these sort of early adopters who ended up with the vast majority of the coin, and they're going to take on risks to be able to loan that out. But to any borrower, it's still going to be the same implications. We're talking about a transitional period where, price identity is price discovery is an ongoing process. And we're starting from an asset that is not as valuable as the entire global economy. And so as that asset climbs in value, the prices that you're going to see in the economy are going to just be so incredibly deflationary that you're going to see a complete lack of productivity. And that it's
if I can steel man your argument, right? You're basically saying that, like, strip away all the jargon and everything, like it for your perspective, and I think many of your perspectives, right? You'd much rather the impulse of credit creation to happen from a decentralized nature, even more so than it is currently with all these private banks that we have across the US and across the globe. You'd much prefer it if the consumer can do a peer-to-peer loan off of their Bitcoin and make that creditworthiness decision as opposed to a pseudo gatekeeper. Okay, sorry. I was trying to steal me. So it's
my depiction of a really powerful economy on this money that can move instantly. And, I think about it in terms of the Lightning Network. But like the whole idea is kind of like taking, instead of having a Wall Street stock exchange, having a Main Street stock exchange. And that, during this period of real strong deflation in Bitcoin and a drop in productivity, there's going to be local demand for real productivity. And people are going to be sitting on this asset that's going to be climbing in value and, struggling to find something to do with it. And I think that the best way to go about it is not necessarily regulation, but more about just general community cooperation to have entrepreneurs present their plans for what they want to provide to the community, and their methodology for funding these small businesses, which has been proven to be a successful model already in the past 10 years, is crowdfunding. But instead of crowdfunding for some product down the line 6 months away, you're crowdfunding for equitable shares. I'm talking about taking a restaurant and dividing it up into 1 billion shares so that the average, small timer, or even less than average small timer, has an accessible investment asset in a local business. And what that develops is, just to round off the point real quick, is a local economy with the operators of these businesses being the largest stakeholders, but a local economy of small businesses, all with 1,000, 10,000 different owners, and every resident in the area having a portfolio of 500 to 1,000 different businesses. That's a sustainable, equitable model.
Luke, I want to let
so
you
you're
chime
basically
in.
saying,
I'm sorry.
You're basically saying lift. And I think I'd agree with this for the most part, but you're basically saying qualified investor limitations that are gating access in inhibiting a lot of this business creation, particularly in the SMB space, less so private equity scale businesses, but you're talking more SMBs. That's a huge issue, right? Is that what you're saying? Like allow a community, a small investor, a regular person to invest in any business kind of a thing?
Yeah, 100%. I don't understand. I think the SEC exists, A, to put money in lawyers' pockets, and B, because we've centralized this idea of shares of stock. Like if you had shares of stock in a local business, you'd want to own those shares, and not for the speculative value of the stock, because there'd only be a small market participating in investing in it and trading it. But you'd be much more interested in the dividends that can be earned. And on a network like Bitcoin and Lightning, you could earn those dividends on a daily basis, creating extreme monetary velocity. That's disposable income. Money moving, money storing.
Hang on, Luke.
Listen, like 20 years ago, I think I largely disagreed with that. Like today I mostly agree with that, because the number of opportunities out there in terms of businesses is so much smaller than the amount of dollars available. The literal like cash available for investment in those businesses. So I just think you naturally have a supply demand imbalance there that's inhibiting growth. So I agree with you totally there. 20 years ago, I probably wouldn't have because of like scams and stuff like that, particularly in 2000 and 2001, that I think given that imbalance wasn't as large, I think it was harder to kind of cope with. But like similarly, like nothing inhibits you from investing in your local convenience store at present. There are a number of things like traceability that I think make it hard. Like you're not sure if the dude's taking cash under the table and withholding earnings from you, maybe the dude or the girl or whatever who owns the convenience store. But I'm not entirely sure Bitcoin is in order of magnitude innovation in that, although there are traceability things and maybe some kind of like level 2 smart contract you could do. I think D++ is probably better authority than I am on that one. That could assure traceability and stuff like that. So, if you invest in your local convenience store and he's taking money on the table and hiding it from you as an investor, like I think I'd listen to that argument if that's the argument that you're making, DeBlage.
Luke,
Yeah,
I wanted
100%.
hang on, guys. Luke, I wanted to, he had his hand up earlier. I wanted to get his take on this. And I also wanted to weigh in on something that you said, DeBlege, and then we're going to take a quick break. And then I'm going to get D++ up to give you her take after the break. So, Luke, what did you have?
Yeah, I put my hand down because we kind of moseyed past that topic.
Got one past that? Okay.
Yeah, I was just going to double click on the point Anthony made earlier that he said 60% of Americans own their home. What happens if we take away debt? And he also kind of said, like the everyday American needs debt to be able to go out there and afford business ventures and investing in this and buying a home. And I would kind of say that, the reason they need debt to be able to afford all of these things is because of the debt. The debt bubble has, lifted the price of assets and lifted the price of investing in XYZ company. And I just think the problem is debt. The solution isn't add on more debt to that problem.
I wanted to just kind of echo what the Bludge said earlier, because he's talking about, severe deflation and there's going to be less productivity because we're going to have to weigh. And I think, correct me if I'm wrong, but if we have this asset that is constantly growing in value and we have to weigh the understood growth of value of that particular asset, which is Bitcoin, against the possibility of investing in a business that is going to innovate or create what's supposed to be profit, then there are going to be fewer and fewer ideas that are going to do better than the growth of Bitcoin. And that's a struggle that I've had over the last couple of months is, are we going to be willing to invest? And I've asked this question of a number of people, and it is this.
Yeah.
And the question is this: if I invest 5 Bitcoin in your business, Anthony, okay, understanding that in 5 years we're going to liquidate, we're going to have innovated something, and we're going to, we're going to liquidate the company after that 5 years. And you do what you do, you innovate something, everybody is the better for it because it's a great innovation for the entirety of the world. Okay. And then after 5 years, you say, Nate, we did great. Here's your 5 Bitcoin back. Okay. No profit, just the 5 Bitcoin. Am I better or worse off for that? Am I happy or am I upset about that? And I would dare say that I'm happy about that. I would be happy about that because that 5 Bitcoin is going to have a higher purchasing power because of the innovation, and because that 5 Bitcoin is actually going to be worth more 5 years later than what it was the 5 years ago when I actually invested it. And that's going to be a tough paradigm shift for investors to actually get a hold of with a deflationary currency.
Yeah, but couldn't we create, just some sort of like, it's all digital. All this information is like centered on a main network, and like if it's all information and it's to all of our benefit, couldn't we create some sort of user interface tied into all of this that kind of explains the purchasing power side of the value instead of just the quantity? You know what I mean? Like how are prices dropping? And
that's a project and an education that has to take place, though, and that's where it needs to start, though, is re-educating people that are so used to getting a 3 to 5% raise every year because doggone it, I deserve it. Okay, that's not going to be the case anymore, because if you have the same amount of money, or even if you take a 2% pay cut, you're still going to have better purchasing power next year, with the job that you have, because the asset that you're making and saving is going to be worth more through that year than what it was when you took the pay cut. That's a mindset that not a lot of people are even recognizing, might have to occur. And with that, I do want to let, there are a number of hands up. I told D++ that after the break, I was going to let her go ahead and talk. So give me just this second. We're going to be going into overtime right after this. Shamri is a fun and engaging game for the whole family. A twist on the familiar memory card game, playing Shamri will help you and your kids ask questions and learn about how Bitcoin mining works. A STEM-authenticated educational product, you can be sure Shamri will be a great help as you teach your kids about Bitcoin. Order yours today at shamri.com. That's SHAMORY.com and use the discount code EFFECT to save 10% off of your order. The conversations in this Twitter space are being recorded for use on various media platforms, and any contributors to the conversation irrevocably consent to the recording and distribution of reproductions of the contributor's voice and performance as part of this program. Welcome to
By the way, that applies to all TBS shows. Go ahead.
Do you want that? I can get that clipped for you so you can actually play that for the other shows. D++, welcome to Overtime. It's been a long time since you and I have talked. What have you to add to the conversation?
Oh, hey, yeah, thanks for having me. I would love to contribute to the conversation, but I have no idea what you guys are talking about, unfortunately.
There are points in time when I didn't either. It's okay.
That's perfect. Right on. Thanks.
And actually, I know that being the case, if you want to just listen into the overtime while some other people are actually kind of climbing on to what we were talking about before the break, then by all means do. But it's good to see your icon again and to hear your voice. Good to see you, Henry. What have you to add to the conversation? I know you had your hand up earlier.
I think this would be interesting to some here. And Matt, let's consider the possibility of deflationary prices, right? Prices falling because of Bitcoinization. And in the long run, there's going to be a gradual growth in the purchasing power of the coin as the real economy is growing, right?
Yep.
So imagine that's the case. Some people think there's going to be less credit because of that. I think they're not right. Let's work through a chain of reasoning quickly. Imagine that some other party and I agree on a loan with a 9% interest rate. Every loan has three components. One is time preference. The other is creditworthiness. And the third is inflation or deflation expectation. So those are the three components. Let's say they're each 3%. In a deflationary environment, the third component, what Mises called the price premium or inflation expectation component, let's say it's negative 3%. We expect the party and I agree that or rather our agreement to have a 9% interest rate, we can infer that there's this component, let's say it's 3% negative, in terms of the prices are going to fall 3%. The general price level of the economy will fall 3%, each year. That's the deflation expectation component. But the other two components were positive 3%. 3% for time preference, in other words, the difference in my interest in consuming now versus later, versus the borrower's interest in consuming now versus later. The difference is 3%. And then the creditworthiness, I think they have a 3% chance of default or something. So what we end up is 3 plus 3 minus 3. So there's still a 3% interest rate that is resulting from these components when you add them up. So even though there's a deflation expectation, there still can be a positive interest rate. So I would want to lend out my Bitcoin and get the return of hodling plus the interest that I'm going to be paid back. Maybe that I'd secure or collateralize the loan with some property. So this, involves some trust, but real economic activity tends to do that, right? People dine at a restaurant and then dash off sometimes. We can't have everything be trustless in society. So I think that there still can be lending even when prices are falling. This is proven in history. If you look at the gold standard during the 1800s, prices were falling in many places where gold was used, and still there was plenty of credit. In Holland, in history, look at where gold was used, commerce existed, lending existed. There was a stable fractional reserve regimes there. And my point is that people who think that falling prices mean there's no credit because everyone will hodl are wrong. In fact, the proportion of wealth in the society held in money will grow. As the store of value premium rotates from stocks and real estate into money under Bitcoinization, the total amount of wealth held in money is going to be larger as a proportion of total wealth than it was under fiat. And therefore, the supply of loanable funds will expand, causing a natural expansion of credit. Natural meaning free market activity that's sustainable as opposed to an artificial inflation-driven credit expansion.
To pile on your point, though, Henry, too, and this is something we haven't even discussed as part of credit, is the lending of labor. When you consider a contractor or somebody who's willing to take payment later for labor or services that they're giving now, that too is part of the lending process, and that is an extension of credit as well. So it's not as though credit's not going to exist because all we have is a one-to-one basis for lending. It's a matter of are we willing to take on the credit worthiness of the person that we're doing a service for and taking payment later? That's also part of the economics that I think you're talking about.
Yeah, I just think that credit is part of the free market, just like equity, and the government and society should be neutral always with respect to the savings rate of the society. Let the consumers decide. We shouldn't be like supply side Reaganites trying to force people into more productivity and saving, and we shouldn't do the opposite and try to get them to stimulate and spend and go into debt. The government should be neutral and let the market decide, let the consumers decide in the competitive entrepreneurial process what the rate of savings is, what the rate of lending is. So I just don't like any kind of central planning of this economic behavior. And I agree with what Thebledge, I think, was saying about how, we'll have much less credit because the Fed isn't going to be doing these credit expansions. But I also think there won't be none. So I think we're kind of all very much in agreement on these concepts, and they're in the distant future. So it'll be interesting to see how it works out.
I got two hands up. I'm going to pick the Bledge first, and then Anthony can go ahead and respond as well.
Yeah, I was just going to respond to what you were, the idea of deflation and because I put a lot of thought into this idea of a really, strong web of, equity and having individuals have a piece of a lot of different businesses. And I think about what that increased disposable income does as a combatant towards deflation. That inherently, by circulating the money, while you are increasing the purchasing power, you're technically providing more disposable income, which is balancing to that effect. And so monetary velocity, in my opinion, is as it increases, it battles deflation. And that's why I still think that if we can capitalize the majority of businesses out there in terms of equity, and then think about capitalizing mortgages in terms of free market competitive lending, that's the optimal economy.
But how many mortgages are actually going to occur if we don't have the opportunity, and opportunity is the wrong word, if we don't have fractional reserve banking as a tool to utilize for all of those people that are going to want these 8 million houses that we're supposed to build in the next couple of years that we can't in the United States?
Yeah, well, those houses were going to be rented to people who could own them. So it's a matter of affordability. I kind of envision the future, where mortgages are not.
How does it change, though? Because the payment's either the same or more for a renter than it is for a homeowner. So how do you rectify the difference?
I'm sorry, say that again?
Because the monthly payment, if we're going to consider monthly payments still on a mortgage and in a Bitcoin economy, which I think is untenable, there's those payments are still relatively equal. Now you're just talking about the credit worthiness or the asset availability of somebody that either can or can't own a home because they do or don't have a down payment available to them. So, I don't think that really changes that much.
Well, let me finish real quick, and I'm just, let Anthony go. But sure. I think the way I view the future of lending when it comes to being able to get a mortgage on a property is that there's going to be a bunch of owners of contractors who are going to build up this productivity and lend these homes to people that are then going to pay them a monthly over time and eventually pay off that loan in that manner. So it's not a financial loan, it's the actual house is being lent. That's kind of how I envision that.
And then you're talking about the credit worthiness of all of those borrowers as well. Anthony, you've got your hand up for. Go ahead. What do you got?
Yeah, Nate, you pretty much said what I would have said to that. I want to go back to address what Henry was saying, what you were saying. Like, I thought your example of like Henry's talking about credit creation. You're talking about investment in the terms of, I think your example was you give 5 Bitcoin to a business, you come back a few years later, you get 5 Bitcoin back from them. Why wouldn't you do that? Kind of a thing, assuming that Bitcoin continues to appreciate in value. That's totally correct, right? I think we're talking about a Bitcoin standard there, where Bitcoin is really like the medium of exchange and really all that you care about.
That's an educational paradigm that we've got to fix.
Yeah. So, just with respect to that, right? Like, I think this, the answer lay in between you and Henry that I want to get to here. But if Bitcoin's going to appreciate, why do you risk that 5 Bitcoin by investing it in a small, mid-sized business to begin with, right? Like, there's no point. You just hodl that 5 Bitcoin, right? You can do it out of the altruism of your heart, but to Henry's point, you would lend that for a margin. You would lend that for an interest rate, the credit worthiness, whatever, right? That's why you would do it. If you're just getting 5 Bitcoin back, then you would save it, which gets to the whole conversation about inflation, deflation, whatever. And we've talked about this before. There's a bandwidth in which acceptable inflation or deflation outlooks are manageable, but outside of that band, they have perverse incentives in that if you're doing 10% deflation a year, 15% deflation, I don't know where the number is, nobody knows where the number is, but a substantial enough amount of deflation a year, you'll curtail investment. So that marginal business, some businesses will get funded. Some of those businesses that get funded are going to go bust. We're terrible as investors at picking winners and losers, right? Once it's self-evident that you have winners and losers, like we pile on, and that's great. They become the Googles of the world by virtue of economies of scale and other factors, right? But like in terms of identifying credit-worthy businesses or equity-worthy businesses, we're terrible at doing that. So like in your example of the 5 Bitcoin, Henry's assuming a system of credit, which I can address in a second. I think you're assuming, or at least your example, just narrowly was no credit. You have 5 Bitcoin.
Yeah, my example was equity. Yes.
Okay, yeah, so purely equity. So 5 Bitcoin, you give it to the Shopee, and what happens with that 5 Bitcoin? Well, the Shopee spends it, right? They send it to someone else, who sends it to someone else, who sends it to someone else. It gets not rehypothecated, because that's the wrong word, but it gets passed along a daisy chain of liabilities and contingencies and stuff like that, right? If in 5 years you're expecting your 5 Bitcoin back that your Shopee, that you invested in your Shopee as equity, and that Shopee, that business, the convenience store, hasn't done well enough that he's got 5 Bitcoin to give you back, well, then he's got to go to somebody else to try to find it, or what happens is you become a seller of the rest of your Bitcoin. You put downward price pressure on the rest of your Bitcoin, right? This gets to the question of, why does that matter, right? 1 Bitcoin is 1 Bitcoin. Totally, I get it. But you're not eradicating other currencies in the world. There will always be other currencies in the world. And even if you were, this matters because the real price of what you give a damn about is the stuff that you buy with that Bitcoin. The stuff that you need that 5 Bitcoin for is why you care. So if you have this daisy chain of contingencies, you gave 5 Bitcoin as an equity investment in your shopkeeper who spent it on food to stock his shelves. That food company spent it on wages for their employees and stuff like that. If that whole daisy chain, somewhere there's a chink in that armor along that chain, and you Bitcoin back, you've got to sell what Bitcoin savings you have elsewhere, which puts downward price pressure on Bitcoin, which means Bitcoin writ large can purchase less, commodities, food, housing, stuff like that. Do you get me?
I do, but with the equity position that I had, I'm also risking numerically the amount of Bitcoin that I'm going to get back after the investment is done. So so from a credit perspective, I totally understand. He's got to try to figure out a way to pay that back, and I think that's it's more untenable to do it that way than it is to try to gain or try to propose an equity position to an investor. I love what was going on here. We've had a fantastic conversation as far as economics is concerned and what can or cannot happen with Bitcoin and credit. It's going to the top of the hour though, and I'm going to turn this over to Log and turn this into Bitcoin and Chill. Make sure to be on Twitter later today for Off the Deep End with Tomer Strolight at 7:30 p.m. Eastern. It's 4:30 Pacific, followed by Big Brain Bitcoin at 9 p.m. Eastern, 6 Pacific, where you'll never know who might show up. Thank you, everybody who's joining me on the stage. Anthony, for being my impromptu guest today. Make sure to join me next Tuesday for The Bitcoin Effect. Log, thanks a lot for letting me go a little bit long. D, I wish I had you up here a little bit quicker. Anthony, great conversation. Henry, the Blaise, Jal, thank you guys for contributing, and Luke as well for making this a wonderful conversation to enjoy this afternoon. I will look forward to seeing you guys again next week. Thanks, Log.
Yeah, thanks, Nate. This was a great episode, like a great conversation. I didn't stream it live to Bitcoin, but I did record, audio and video so I can upload it. And this was, you never know when you're going to just get a really great conversation like this.